From April 2027, if you're under 65, the cash ISA limit is dropping from £20,000 a year down to £12,000 a year. And the headlines were furious, right? An attack on savers. And on the surface, that outrage about the reduction in the ISA allowance makes complete sense. But after about 15 years of sitting across from real people with real money, I actually think this might be the most accidentally useful thing that the government has done for your finances in a long time. Not because cutting the limit is like inherently good, but because of what it exposes. See, most people who are upset about this are planning on keeping a cash ISA filled with money that has like no real destination, no objective, no time frame. Just a vague sense of kind of being responsible. And that habit, that well-intentioned, feels sensible habit, is quietly costing you a fortune. By the end of this video, you are going to see that the account that you actually save into should follow your objective, not the other way around. But first, we need to talk about the mistake that it exposes and why it probably doesn't feel like one right now. Look, here's the thing about cash ISAs. Most people aren't using them badly because they're reckless. They're using them badly because saving anything at all feels like the right move. And it is, right? The problem isn't the act of saving. It's that no question has been asked before the money goes in. And the question is this: what is that money actually for? When do I need it? Look, I've worked with a lot of people who have genuinely impressive savings, right? Like 20, 40, 50, 60 grand, sometimes more, just sat in a cash ISA. And then when I ask them this simple question, what is that actually for? The answer is usually something like, just in case, or for the future. Now, that sounds fine, but for the future, it's not really a plan, is it? So let me give you 3 examples. Same person, 3 completely different pots of money. So first pot, you're saving for a holiday in 12 months. You need that money exactly where you left it. Certainty is everything for this, right? Cash is absolutely the right call. Any risk in that short window is an absolute disaster that you just do not need. The second pot, you want to renovate your kitchen in, say, 6 or 7 years' time. Now, you've got a bit of time on your side, right? You don't need the certainty of cash in exactly the same way. There is room to take some more measured risk and probably room to grow that money meaningfully before you actually need to touch it. And let's say in this case, the third pot is retirement in 25 years. Now that is a completely different game altogether. The rules that apply to your holiday fund in 12 months do not apply here. And treating them in the same way is where the real damage happens. Look, same person, 3 objectives, 3 completely different answers. And once you understand this notion, the debate around a cash ISA starts looking very, 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 very different. So there is the assumption that almost everyone I meet carries around, okay? And this assumption is this, that cash is safe and that investing is dangerous. And honestly, I get it, right? Because that feels completely logical. You put your money into a savings account and the number goes up a little bit every year and nothing really scary happens. You put your money into the stock market, on the other hand, and that number can drop overnight and suddenly you're reading headlines about financial collapse. Of course, cash feels safer. But I want to completely tip that on its head because I think that most people have the risk picture completely backwards. And the longer your time frame, the more that kind of misunderstanding can cost you. Cash is only safe in the short term. Investing is only really dangerous in the short term. But stretch the time frame out and the whole thing reverses. That is the inversion. And once you start seeing things in this way, you cannot unsee it, right? Let me show you what I mean. Take £500 sitting in a savings account in 2012. Today, based on the Bank of England's inflation data, you would need that to be around £710 today just to buy the same things that 500 quid bought you back then. So if that money sat in cash and earned roughly kind of the rate of inflation, you'd really just have broken even, just about. But the moment that your interest rate dips below inflation, which happens constantly, you're losing ground silently and consistently over time. The number on your statement looks fine and chips up every single year, but what you can actually buy is shrinking. That is a way bigger risk, in my view, over the long term. And also, between 2021 and 2023, the UK inflation topped 11% at its peak. The worst run for like 40 odd years, I think it was. Cash savers during that period were losing purchasing power faster than any point since like the early 80s. Nobody sent them a warning letter to tell them about that. The statement still showed a positive balance, but the damage to your cash during this time is invisible. Now, on the other side, yes, look, the stock market is genuinely volatile in the short term. I'm not going to dress that up, right? In 2008, in the global financial crisis, equities fell by 50% roughly from peak to trough, from top to bottom. If you needed that money, if you needed to get your money in 2009, that was a disaster. I'm not going to pretend otherwise. Absolute disaster. But here's what changes when you zoom out a little bit. Vanguard did a study around rolling 10-year windows for globally diversified stock market investors and found positive returns, so not losing money, in over 90% of those periods. So for all of those rolling 10-year windows, whenever you started, you made money 90% of those times, regardless of market conditions. In the longer windows, the longer the window, essentially, the closer it got to 100%. Now, time doesn't eliminate risk entirely. Nothing does. But what it does do is it transforms volatility. The amount by which things go up and down, from like a threat that makes you worried to just kind of background noise, right? So the real question isn't, is cash safe or is investing safe? The real question is, safe over what time frame? And that changes absolutely everything. Now, I want to deal with something that people always get wrong at this point. They hear, okay, cash bad, don't use cash. And they immediately think that what people are saying and what I'm saying on this video is, hey, put everything in the stock market, get investing. I'm not even close. Because between cash and the full stock market, there is an entire spectrum. And that in the middle is where the interesting stuff lives. Look, think of this like a dial, right? All the way on the left, you've got cash, maybe 1 or 2% return over time, but almost no volatility, right? It doesn't go up and down. However, you get negative real returns once inflation does its thing. All the way to the right on this chart here, you've got equities, the stock market, effectively. Historically, that will return you, let's say, 8 to 10% a year on average, but with the occasional absolute gut punch of dropping by 30 to 50% in a bad year. Now, somewhere in the middle, you've got assets like bonds, right? These are essentially loans. You lend money to the government or companies and they pay you interest. Historically, these have run at around 3 to 5% a year with a lower volatility than equities, than the stock market. Now, one thing about bonds, you have probably seen, but bonds had an absolutely horrible time in 2022 and 2023. Some bond funds fell equity-like numbers, right? Like 25 to 30% as interest rates spiked and inflation kicked in. So I'm not pretending that bonds are without risk, But as a medium-term option that sits above cash on the risk scale without the full drama of the stock market, they're definitely worth at least understanding, I would say. And don't let your short-term experiences and views of bonds taint the fact of why you would actually use them in a portfolio in the first place. That is the most important part of all of this. The rule of thumb is this: the longer you can leave your money alone, the more that dial you can afford to turn up towards the equity side of things, because time is what smooths out the bumps. So let's make this practical, okay? Let's actually get some frameworks in place here. The sequence for deciding where to actually save your money and where to maybe diversify away from a cash ISA is always the same. It's always the same, right? There is nothing new under the sun when it comes to deciding where to save your money. Firstly, figure out your objective, figure out your goal. What is it you're trying to achieve? Then understand the time frame and the timeline of what that means. Then you'll naturally be able to choose the account type that fits that goal and time frame. Then you'll naturally be able to choose what fund or what investment mix will work with all of those things. So let's say, for example, it's under 3 years. There's an argument to boost that up to 5 years as well, but for the time being, just say 3 years. Anything that you need the money under 3 years, just keep it in cash. Look, a cash ISA, or not even bothering with the ISA side of things, an instant access savings account is probably just the right call. You're not going to win by taking stock market risks within the short term. Certainty matters more than growth at that distance. A 20% drop 6 months before you need the money isn't a learning experience, it's a disaster. Don't apologize for keeping short-term money in cash. That is not a mistake. That is sensible. But 3 to 10 years, this is where things like a stocks and shares ISA starts to make sense. Again, not necessarily all in equities, but just not sitting all in cash either. You want something in between. Now, this is where things called multi-asset funds kind of earn their place. So a multi-asset fund is essentially a one-stop solution. To be honest with you, for most people, all you will ever need is one multi-asset fund for the rest of your life, okay? So rather than you having to pick the split between which allocation of stock funds and bond funds and all of those things that's right for my allocation, and then manage those investments yourself and figure out the split, a multi-asset fund does all of that work for you inside one individual fund. So you choose a predefined risk level that you're comfortable with and matches your goals and timelines. The fund holds the appropriate amount of equities and bonds and sometimes other assets, and it maintains that balance for you automatically. It's genuinely brilliant for people who just don't want to overthink it. It's really important. So here's roughly what that looks like in practice, okay? Across these levels of sort of fund allocations, okay? Now these are the Vanguard Life Strategy Fund ranges, LS. And the number refers to the percentage in equities, okay? So these are the 10-year roughly annual returns. So for LS40, that's 40% equity and 60% bonds, roughly, has returned around 5 to 6% a year over the long run. But in a bad year, you might see it drop by 10 to 15%. Uncomfortable, but manageable. The LS60 steps it up a little bit, right? With 7 to 8% a year historically. Now, historically, it drops maybe, 20% in a bad year. The LS80, where it's got 80% of the money in the stock market, starts to push up to 9% a year. But now you are looking at potential drawdowns of 25 to 35% when markets really take a turn. And then there's LS100, pure equities, no bonds, sits at around 10% per annum over the long run. But with that, you're accepting the full swing of the market. That means that if you put £1 into that, it could well go down by 40 to 50% during a serious market crash. It has in the past and it will again. So as you can see quite clearly, as the returns go up, the gut punch potentially that can happen to you goes along with them. It's not a flaw in the design. That's exactly how it's supposed to work. You are being compensated for tolerating short-term noise. The LS40 grows above cash over time without you having to ride out 40% drops with your eyes closed. That middle ground exists, and for most people, you just don't know that you're looking for it. So 10 years or more. Now, genuine equity exposure makes real sense, okay? So life strategy 80 or 100 for 10, 15 years for adventurous people, absolutely fine. Yes, the short-term movement might be bigger, but the 2008 crash, which felt like the end of the world at the time, had been fully recovered and then some within a decade for a diversified investor in that sort of thing, okay? The trade-off never changes. More equity means higher expected return and more short-term movement. Less equity means a smoother ride with lower long-term growth. Neither approach is wrong at all. They're just completely different, and it depends entirely on the job that your money has. Now, that brings us back to this cash ISA rule change. The cash ISA limit dropping to £12,000. It is not a punishment. It is a accidental nudge, forcing a question that most people have been avoiding for years. For most of you watching this now, it won't hurt you at all. I can assure you of that. It just exposes that the tool that you were maybe reaching for wasn't the right one for the job. Now, there's a risk tool linked in the description below for you to download for free. It takes 5 minutes, gives you a broad picture on the dial of where your money probably belongs. So match your risk profile and your time frame, and you're going to have a real starting framework to work off of. Again, don't take it verbatim. Do your own research, but it will just start you thinking off as to say, okay, well, maybe 100% equity isn't the right thing for me. Now, speaking of cash ISAs, and in fact, all types of ISAs, to be honest, it can often be very difficult to choose which one might be right for your own personal circumstance. And I think there's a big misconception about kind of which one is better than others, which is why I think you should really watch this video here next, because this is the exact topic that I run through, and I'll give my opinions on all ISA options ranked from worst to best. So give it a click and I will see you there.